Have you ever wondered about the financial health of the company behind your favorite chocolate bar? Well, let's unwrap the sweet world of the Hershey Company, a name that has been synonymous with chocolate for over a century. Established in the year 1994 by Milton S. Hershey, this Pennsylvania-based company has grown from a single product venture to a global confectionery giant. With a portfolio that boasts some of the world's most beloved brands like Hershey's, Reese's, and Kit Kat, the Hershey Company has truly transformed the way we satisfy our sweet tooth. Operating in the confectionery industry, Hershey's has carved out a significant market share. This industry, which encompasses everything from chocolate and candy to gum and mints, is a highly competitive landscape, marked by innovation, flavor trends, and an enduring love for all things sweet. Yet, through its unwavering commitment to quality and its consumer-focused strategies, Hershey's has managed to remain a key player in this dynamic arena. The Hershey Company's influence extends far beyond the boundaries of the United States. With operations in over 60 countries and its products sold in around 200 countries, Hershey's global footprint is testament to its universal appeal. But Hershey's isn't just about creating delightful treats. The company has also been a trailblazer in areas such as sustainable sourcing of cocoa, responsible marketing, and community outreach programs. Its commitment to creating shared goodness has made Hershey's not just a leader in the confectionery industry, but also a company that sets the bar high for corporate social responsibility. So whether you're a fan of the classic Hershey's milk chocolate bar, the peanut buttery goodness of Reese's, or the crispy wafers of Kit Kat, remember that you're not just enjoying a delicious treat. You're also partaking in a rich history, a global presence, and a company that believes in doing well by doing good. Now that we have a general understanding of the Hershey Company and its industry, let's delve into some financial metrics. How has Hershey been performing financially over the past decade? Let's break down, starting with the annual compounded growth rate, which gives us a comprehensive picture of how a company's profitability has grown over a set period. For Hershey, we'll examine the past 10 years. In terms of revenue, Hershey has exhibited a steady upward trend. The 3-year CAGR is 11%, 5-year CAGR is 7.5%, and 10-year CAGR is 4.5%. This reveals a clear uptrend in revenue over the last 5 years and even more so in the last 3 years. Such stability is a positive indication of the company's capacity to consistently boost its sales and market share. Next, we move to free cash flow, which is the cash a company generates after accounting for cash outflows required to maintain operations and its capital assets. The 3-year CAGR stands at 8.9%, 5-year CAGR at 4.2%, and 10-year CAGR at 6.6%. Hershey's free cash flow has also been consistently increasing over the past decade, gaining momentum particularly in the last 5 years, and even more so in the last 3 years, pointing to its efficient management of cash and resources. Net income, the company's total earnings after all expenses have been deducted, is another vital metric. The 10 years CAGR is 8.8%. Hershey's net income has been increasing, signifying that the company is profitable and has been effective in cost management. Let's now explore assets. The 10 years CAGR here is 8.3%. As Hershey's assets have been growing over the past decade, it shows the company's strategic investments in growth opportunities. We should also look into liabilities, which has a 10-year CAGR of 7.8%. It's essential to know this as well as it shows the financial obligations the company has. Debt can be a double-edged sword. It can propel growth, but an excess can be a liability. The 10-year CAGR for Hershey's debt is 9.6%, indicating that Hershey has managed its debt level effectively over the past decade. Hershey has maintained a balance that fosters growth without imposing an unsustainable obligation. Finally, dividends. 10-year CAGR for dividends is 8.2%, and the company has been growing its dividends for 14 consecutive years, a clear sign of its commitment to returning value to shareholders. These metrics reflect Hershey's financial performance over the past decade. But how strong is Hershey financially? Let's find out. What do the debt levels of Hershey tell us about its financial strength? To answer this question, we delve into the intricacies of Hershey's balance sheet and examine key ratios that provide insight into the company's financial health. Firstly, we look at the debt-to-EBITDA ratio, which measures a company's leverage and its ability to pay off its debt. This ratio for Hershey is 1.8, which is considered normal as it's less than 3. EBITDA, or earnings before interest, taxes, depreciation, and amortization, gives us a clearer picture of Hershey's operating performance by stripping out non-operating costs. A lower net debt to EBITDA ratio suggests that Hershey is generating enough income to pay its debts, hence showing financial strength. Next, let's consider the debt to free cash flow ratio. For Hershey, this ratio is 3, indicating that Hershey can pay off all its debt with just 3 years of free cash flow. Free cash flow is the cash a company generates after accounting for capital expenditures, and it's a key indicator of financial flexibility. A lower ratio indicates that Hershey has sufficient cash flow to service its debt, which is a positive sign of financial strength. Thirdly, we examine the debt-to-equity ratio. This ratio for Hershey is 1.24, which is higher than the preferred maximum of 1. This provides insight into the company's capital structure and how it finances its operations. A lower debt-to-equity ratio suggests that Hershey relies less on borrowed money and more on its own equity to finance its. This reduces financial risk and indicates financial stability. Finally, we look at the current ratio, a liquidity ratio that measures a company's ability to pay short-term obligations. For Hershey, this ratio is 1.1, which is acceptable. A current ratio above 1 indicates that Hershey has enough assets to cover its short-term liabilities, suggesting strong liquidity and a healthy financial position. In summary, analyzing these ratios gives us a comprehensive understanding of Hershey's financial strength. It's important to remember that while these ratios provide valuable insights, they should not be looked at in isolation. They are pieces of a larger puzzle that, when put together, paints a holistic picture of Hershey's financial health. Understanding Hershey's financial strength is crucial. However, it's just as important to assess its profitability. Is Hershey a profitable enterprise? Let's delve into some key metrics. Our first checkpoint is the net income margin. This margin is set at 17%, a clear indication of robust profitability. This signifies how efficiently each dollar in revenue is transformed into profit. Moving on, we have the free cash flow margin, which stands at a hearty 14.5%. This not only denotes robust profitability, but also showcases Hershey's impressive knack for cash generation. Next in line is return on invested capital, more commonly known as ROIC. Hershey's ROIC is pegged at an above-average 25%, showcasing the company's proficiency in converting its investments into profits. The return on assets, ROA, is marked at 17%, a high figure that signifies a compelling usage of assets to generate income. Jumping to the return on equity, or ROE, we have an impressive figure 53%. This essentially measures the ability of the company to generate significant returns for its shareholders. All these point towards Hershey being notably profitable. Now let's check the current valuation of the company. Let's dive into the valuation of the Hershey Company. We commence with the most common metric, the price-to-earnings ratio. Currently, it stands at 19.7, which is below the 10-year average of 27. This results in an earnings yield of 5.1%. We then shift our focus to another significant ratio in assessing a company's valuation, the price-to-free cash flow ratio. It measures at 23, falling under the 10-year average of 25, and provides a free cash flow yield of 4.3%. The current dividend yield is another vital metric that could suggest whether Hershey's stock price is undervalued or overvalued. At this moment, it is 2.6%. Exceeding its 4-year average of 1.9%. The dividend payout ratio, meanwhile, is a steady 51%. The free cash flow payout ratio is sustainable at 58%. Let's take a closer look at the people steering the Hershey ship. The captain and first mate of this confectionery giant are the CEO and CFO, both of whom have held their positions for several years and own a significant amount of shares in the company. Their personal investments in the company further align the management's motives with that of the shareholders, setting a firm course towards the company's success. Stock-based compensation is only 4% at the free cash flow, which is in line with shareholders' interests. At Hershey, we have consistent dividend increases and continual share buybacks. Hershey has a record of increasing dividends for an impressive 14 consecutive years. By buying back its own shares, the company decreases the total shares in circulation, effectively increasing the value of those that remain. The number of Hershey's outstanding shares has been declining with about 1% per year for the last 10 years. What's the actual worth of Hershey's business? To answer that, we'll calculate the intrinsic value of the company using the free cash flow discount model with an 8% discount factor. and subtract the debt. Now, if that sounds like a mouthful, don't worry, we're going to break it down. So, what is the free cash flow discount model? It's a method used by Warren Buffett to estimate the intrinsic value of a business. This model uses assumptions to project the company's free cash flow into the future. We'll then discount these future cash flows back to their present value, using our chosen discount factor of 8%. This discount rate is actually the expected rate of return. We take average free cash flow for the last 3 years and grow it for the next 10 years with 6.5% per year. This is in line with the generated last 10 years growth rate. We use a perpetual growth rate of 3% after the first 10 years, because this is our assumption for the inflation rate in the next years. Subtracting the debt gives us the equity value of the business, because debts are obligations that need to be paid back. When we subtract the debt, we're left with the value that belongs to the shareholders, the intrinsic value. Then we divide it with the number of shares outstanding, and we get $201 per share. We use 20% margin of safety to determine the ideal entry price, and it would be in this case about $160 per share. So, after doing the calculations, what does the resulting figure mean? Well, this figure represents the fair value of the company if my assumptions are correct, regardless of its current market price. The current stock price is about $183 per share, so it means that according to our estimates, it trades below its fair value and offers about 10% margin of safety with possible 8% rate of return per year for the next 10 years. I personally own shares of Hershey. I'm not a financial advisor. This video is for entertainment purpose only. If you like the video and if you learned something new, give me a like, subscribe to the channel and hit that bell notification. If you want to learn how to do such analysis of any given company, join my Discord channel using the link in the description below, and by doing so, you will get in the first 4 months the whole stock analyzing course that I created together with my discounted free cash flow calculator and my portfolio spreadsheet. And last but not least, you will find in my Discord other investors just like you to discuss investment ideas, brokerages, portfolios, and much more. Our group is growing. Join us. See you in the next video and let the market be with us.